Hi, and welcome to the Optimizing Personal Finance podcast. I'm Tom Mihawk, and I'm preparing this podcast for use in my teaching activities as part of teaching personal finance courses. This podcast today is going to have three components. The first two will be 10 minutes roughly each, and the last maybe 15 minutes or 20. First is going to be some things to know. These are vocabulary words. And I know that sounds boring, but these are terms, things that students ask me about in the course, in my courses, and they say, I don't know what they are. I don't know what the stock market is, or interest rates, or why do I need to know these things, or inflation. And so we're going to talk about some of those things. Next, we're going to talk about books, blogs, and influencers in personal finance. And these aren't necessarily the best ones, but these are among the ones, not all, but among the ones that I think you should know something about. And we may do a later podcast and tell you about more. But for now, these are the ones that among the ones I think you should know about. And then last, I have an interview with a former student of mine, Hema Ketter. Hema works in real estate in New York City, works for a very large firm called Compass, very well-known firm. Hema was in my personal finance course as an undergrad, 2015, I believe. And so he's maybe 5 or 6 years out of undergrad, and he was always very purposeful. He's had a successful real estate career and he's building it, and we'll have a very interesting discussion with him. So with that, let's move on to some things you should know. Let's talk about the stock market. What is the stock market? Well, and notice, by the way, that the next term I have down just below it are stocks. So the stock market is a collection of stocks that indicates whether companies are doing well or doing poorly. A stock, the next term there, a stock is part ownership of a company. It's like, we also call that equity. It's like the difference between your home value, if you look it up or had a real estate agent tell you that, and your mortgage, loan against the property, if you have one, is called your equity. It's what you own in the value of the home. When you buy stock in a company, Netflix, Apple, Facebook, Procter & Gamble, General Motors, Ford, you own a portion of ownership in that company. It gives you some rights, like the ability to vote. It gives you the ability to sell the stock at some future time. This is if you're long, you bought first and are selling later. The stock market are lists of stocks followed. Most are very well known. Companies like Dow Jones Industrials, that's a stock market index. Standard & Poor's 500 stock market index. And when these indexes are going up, when people say the stock market is going up, it means generally companies are doing well. Now, it doesn't necessarily mean that the U.S. economy is doing well if they're all going up, and sometimes they can go down and the U.S. economy can be doing well. But it is a broad indicator of how companies are doing in the economy. And there are different companies that track them. Standard & Poor's is one. It's maybe a 50-year-old index. The Dow Jones Industrials is maybe a 100-year-old index. By the way, these companies get paid if you use their names directly. And by the way, I should say, I'm a financial advisor. Nothing in here in what I'm saying today should be taken as investment advice. I'm not giving any. I'm really defining terms. But nevertheless, I want to make sure to say that. So what are stocks? Well, stocks are part ownership, as I was saying before. Now, there are some companies like the company you start, the coffee company you start, the restaurant service you start, the landscaping company, or bigger ones that you start, or maybe you own with a few other people, and you might own all the equity yourself or in combination with others. But most of the time, you're buying stock through a market providing firm or online, and you own a small piece. You earn the right to a small part of the profits of that. You earn the right to dividends if the company pays it, and earnings per share is a proportion of earnings the company announces, describing how well it's done in terms of generating profits. Your shares that you own give you maybe some voting privileges, gives you the ability to sell the stock later. It's partial ownership. And when stock prices go up, that's usually good. stock prices could go up and the economy could be doing poorly, and that would be bad for you, even though your ownership has gone up in value. But in general, when the stock market is good, going up, when your stocks that you own are going up, your retirement savings is going up, your other savings is going up, your investments, those are generally good things. What are interest rates? We say, just like we say, the stock market is up today, stock market's down today, stock market's doing well. What are interest rates? Interest rates have gone up. Interest rates have gone down. Interest rates did nothing today. Interest rates are the cost of borrowing and the cost you could own if you invest by lending someone money, which is what the next term is, a bond. When you buy a bond, you're effectively lending money to a borrower, the issuer of the bond. Interest rates affect you in your credit card rates. When interest rates are going down, in general, credit card rates are coming down, generally. When interest rates start to go back up again, generally credit card rates are going up. When interest rates are going up, it means the cost to borrow for a home is going up. Now, often when interest rates go up, it's accompanied by a change in inflation and sometimes an increase in inflation, and we'll talk about that in a minute. But interest rates impact you because if you're a borrower through credit cards or through bank borrowing or borrowing to buy a home, as interest rates go up, your borrowing costs go up, making it more difficult to buy a home, or meaning you have to buy a smaller home, or meaning you can't charge with a credit card, or maybe you can't even get a credit card or get a home mortgage. So interest rates impact what you pay as a borrower. Now, when you're lending money, if you're investing in bonds, our next term, when you invest in bonds, you're buying the issuance of someone's bonds. They're borrowing money from you. Now, they make a commitment to pay you back, which is why bonds have a lower rate of interest, generally speaking, than what stocks return, and in particular over the longer term, 5 years, 10 years. Time frame is critically important for stock returns because they tend to be volatile. And the longer time you have, the more that volatility looks like this. Or let me see. Let me do it this way. So it's that's right. Lower left, upper right for you. So even though it's going up and down, in the big picture, it's going up over time, over 5 years, over 10 years. Bonds have a requirement to pay you back. It's called a bond indenture. There's a commitment on part of the company borrowing the money, the company or entity from whom you're buying the bonds. They have a commitment to pay you back, and they commit to a rate of return if you own the bond through the entire time from issuance to maturity. And because of that commitment, because there's a legal requirement for them to pay you back, bonds have a lower rate of return than stocks do. Stocks are more volatile, they're more risky. And because they're more risky, people demand a higher rate of return. Bonds have a guaranteed rate of return, and so they pay lower rates of interest. Now, the benefit is, though, stock might look like this. See, no volatility. And it goes up over time. If you buy a 5% coupon bond and you own it from when it's issued here to when it matures here, you'll get a 5% rate of return. Modest. A stock will look like this. And if you buy Apple stock, 5 years ago, and in 5 more years, 10 years total, it'll have done this, up and down, up and down, up and down, and maybe you'll get a 10% return or something like that. And then that's not guaranteed. We have to look at history, and the past is no predictor of the future, everyone says, right? But it's all we have, kind of, to look at what returns for the future might be. Excuse me. So bonds have a commitment, a bond indenture. The company's required to pay you back what you give them, what you lend them by buying bonds, with a rate of interest, which is great. But because of that commitment, because it's a legal commitment, it's effectively guaranteed. And we measure the value of that guarantee through the bond's rating, AAA, AA, single A, triple B. The lower the rating, the less likely you are to be paid back. And therefore, by the way, what does the company do? excuse me, therefore they pay a higher rate of return. They pay a higher rate of return to offset the risk you're undertaking that they may not pay you back. Let's talk now about inflation. What does inflation mean? Those of you that took a college economics course or a graduate level economics course know inflation. But all of us, by definition, but all of us know inflation. Inflation is when 5 years ago milk cost $3 a gallon and now it costs $3.50. Not short term, but long term. When I was, very young, when I was a child, gasoline I remember was, 35 cents or 50 cents or something like that a gallon. And today it varies between, $2.75 and today it's $3.75 because of recent changes. $3.75 per gallon. Now, gasoline is volatile. Gasoline prices are impacted by global issues, by new presidential administrations in the United States and their views. But the impact of inflation is the fact that gasoline cost 35 cents when I was a child and now it's about $3, let's say. Milk is maybe a better one, or eggs or bread. In a well-functioning economy, some inflation is a good thing. It means that companies can charge more for their products and services over time. But we don't want runaway inflation like you hear about in some countries where milk costs $5 yesterday and next week it costs $50. That's a problem because chances are your earnings aren't going to keep up. They're not going to go up as much. Now, when we talked about interest rates earlier, right? 1980, 81, in that range, home mortgages rates, and I don't have this memorized, but let's say they were 14, 15, 16%, something like that. Today they're 3%. And interest rates in general have come down since the 80s until today. And there's some talk about whether they'll start to go up again. Eventually they will because they're at historic lows. But the impact of inflation on you is that your money is worth less in the future. You can afford less in the future, which is why you need to invest. And that's subject for another discussion. Liquidity means your ability to pay bills. If all you have are illiquid investments, and an illiquid investment is, for example, like a home. Can you sell a home in a week? Sure, but someone's going to come along and say, look, I'll give you half price. I'll pay you in a week. I'll sell it now. Generally, you have to wait longer than that to sell your home. Few months, 6 months. If it's a very expensive home, maybe a year or more. Sometimes you can sell it faster than that, but liquidity is a measure of how fast you can turn an asset into cash. Dollar bills, I don't have my wallet here, but I was looking for a dollar bill. Dollar bills, green paper, are the most liquid, right? They in themselves have value in them. Gold coins or gold bullion, diamonds, jewelry have intrinsic value in the item itself. But a home, a car, these things don't. Artwork, these things don't. They have value in their quality and their location and their utility. And so you have to be able to sell that. And same with stocks and bonds. They have to be sold before they can be turned into cash so you can pay investors back or so you can pay bills. And it's important to have liquidity because if all you have is a home and the investment in your business but no liquidity, you have no cash to pay your bills. And the cash is the last term on our chart for today, on our list for today. Cash means green dollar bills, paper dollar bills. Green means, cash means nickels, dimes, and quarters, like coins. But cash generally means liquid assets. So when you're building your personal balance sheet, for example, someone says, well, how much cash do you have? They don't mean just what you have in paper, green paper dollars and coins. They also mean money market funds invested in savings at your bank, checking accounts, and those things. These things that can either immediately or virtually immediately be turned into spendable liquid money that you can buy food with or pay bills with or that sort of thing. So liquidity and cash are related. Liquidity, again, how fast can you turn an asset into cash? And cash is not just coins and dollar bills, but liquid assets in general, things that are immediately able to be that are themselves cash, or that can be very quickly turned into cash. And with that, that's our first section. Please stay tuned for the second section, where we're going to talk about blogs, podcasts, and personal finance influencers. Thank you.